Today we're going to be talking about our investment property analysis sheet. If you're new here, my name is Joe Massey with Castle & Cook Mortgage, and I specialize in helping homeowners purchase properties, investment properties, second homes, do a lot of work with real estate agents, helping their clients purchase investment properties or their primary residence. And what we'll be talking about today is our investment property analysis sheet. This is a spreadsheet that I put together more than a decade ago, and it has gone through numerous iterations. And today we're going to be talking about version 7 of our spreadsheet. It's going to dive into cash flows, return on investment quadrant, everything that you need to look at a transaction and see, is this a good property that I want to buy? We've laid out this spreadsheet in a really simple to use format. It's locked down so that you only have to fill in 22 fields, and that will give you all of the information that you need to know if this is a good property that you want to buy or not. So let's dive in, walk through a sample property, and see what you guys think. So very first thing, when you open up the spreadsheet, there's going to be a link in the notes below that you can download it from our website, loansbyjoemassey.com. And when you download anything from the internet, it often is going to give you the security warning up here at the top. So the spreadsheet does have some macros and some programming built into it. So you might get this message that says, hey, some of this content has been disabled. Click here to enable content. So the very first step is you want to click that yellow ball. And now you can begin working in the spreadsheet. So the very first couple of things here is all of my contact information. And then one of our partners who's helped us put this together, James Orr with Real Estate Financial Planner. He's actually the person that came up with the return on investment quadrant, which we added to this spreadsheet about 2 years ago. And I'll show you a lot of the metrics and how that works. I think you're really going to like the additions that we've got. And big thank you to James for always being gracious and sharing his information to help us analyze properties. So you're going to start with the instructions here. So we've already enabled content, and then you're just going to simply work your way down the spreadsheet, filling out each one of these yellow fields. So when you first start, there's going to be some errors because this is built in to sort of help you make sure that you're putting in good information and not putting in information that doesn't work for a regular mortgage. So you're going to start with the property address. So let's just call this sample duplex. All right, now this is a real transaction that one of my clients closed on about a month ago that we'll go through the numbers on. We're not going to give you the property address or anything like that for privacy reasons, but this is a real transaction and we're going to see if this is a good transaction or not. So number of units, you click on this drop down. This spreadsheet works for single family, duplex, triplex, or fourplex. If you're looking at bigger properties, this would not be right for something like that. This really is for residential properties up to 4 units. So this was a duplex that they purchased, and this works for primary residence. If you're going to be buying the home, living in it for a period of time, and then renting it out at some point in the future, that's where you might select that this is going to be a primary residence, and then you're going to be analyzing what it's going to look like when you rent it out at a later date. All right, but for our purposes today, this was an investment property. So if you're purchasing the property as an investment, you're planning to start renting it immediately, this is the option you want to select, investment property. Now, down payment percentage. You'll see this little red icon over here. This will help you with some of the requirements that you'll need for down payment. So if you're buying the property as a primary residence, you are going to have a minimum of 3% down if you're a first-time home buyer, 5% if you're a non-first-time home buyer, 15% down if you're buying it as a duplex primary residence, or 25% down if you're buying a multi-unit as your primary residence. The next little box there, investment property. If you're purchasing a single family home as an investment property, we can actually help you with as little as 15% down. You can also do 20 or 25%, but 15 is that minimum. And then 25% down for an investment property, duplex, triplex, or fourplex. So as we go down, you'll see these little red indicators here that give you some notes and tips to help as you go along. So down payment, this particular client, they put 25% down because it was a duplex investment property. That was the minimum down payment for them to invest into the property. Now, when you're putting at least 25% down, there's no mortgage insurance required. But maybe you're buying this as a single family home with only 15% down. Well, two things are going to happen. Number one, it's going to ask you about mortgage insurance. But number two, it's going to say, hey, you're going to need to put more money down because an investment property with only 15% down is limited to a single family home. So if you change it back to a single family, now that error goes away. All right, but in this case, this is a duplex. And so it says, hey, we've got to put down more money. All right, we've got to put down at least 25%. And now there's no questions about mortgage insurance because we're putting down at least that 25%. Now, purchase price on the home was $825,000. So remember, this is a duplex. They bought two sides of the property, or they bought the full property, both sides. It's a 3-bed, 2-bathroom duplex on side A, 3-bed, 2-bathroom home on side B. So they paid $825,000 for it, basically $412,500 per unit. Now, acquisition costs. This is one that is really important, but a lot of people forget when they're analyzing properties. So you highlight this little indicator here, and you're going to see reminder. Be sure to include property insurance, inspection cost, appraisal cost, transfer taxes, title insurance, recording fees, closing fees, any other expenses associated with purchasing this property. Now, loan fees are going to be calculated automatically for you. All right, because we know the flat cost for us to process and underwrite your loan is $1,540. But outside of that, everything else is going to be variable depending on the insurance you select, depending on whether or not you buy down your interest rate, depending on the title insurance company you select, if there's a homeowners association, are there back taxes that you need to pay, anything that might be out there on the property that you have to pay in order to acquire the property. That's what's going to be going here in acquisition costs. For this particular scenario, they did opt to pay some discount points to buy down their interest rate. Also, taxes, insurance, title insurance, everything's a little more expensive on a multi-unit property. So they invested a total of $24,500 for total acquisition costs. All right. Loan costs, that's not highlighted in yellow because that calculates automatically for you. Down payment calculates automatically for you. And that gives you that mortgage balance of $618,750. And then you want to factor in any seller credits. So generally, if you're putting 5% down on a single family home or primary residence rather, you can have a maximum of 3% seller concessions. Or in this case, this was an investment property, so they're able to get a maximum of 2% seller concessions. And it's a percentage of that total purchase price. Now, initially, when they went under contract on this transaction, there were no seller concessions. They were offering $825,000, no seller concessions. But after doing the inspection, they found a few things wrong with the home, that there were some repairs needed. And they knew that it needed some updating, it needed some work done to it. But they did find some issues that they went to the seller and said, hey, you know what, the furnace is kind of aged. And there was some challenges with the roof, I believe. And I believe maybe there was some sewer repairs needed. And they negotiated for $3,500 in seller credits. And then the next thing you're going to plug in are the initial repair costs. Now, this is a number that can vary widely. If you're buying a property that's fully finished, doesn't need any repairs, might not have to put anything in here. In my experience, when you're buying an investment property, it's going to need some type of repairs. Even turnkey properties that I've bought, usually you have to clean it. You might have to clean the carpet. You might need a refresh on paint or cabinetry, something like that. For this particular case, each side needed about $20,000 worth of work. So they had to put in some work to refresh the property. I think it needed some carpet, paint. I think they had to redo one or two of the bathrooms. So initial repair costs, $40,000, $20,000 per side. So now it shows you your total initial investment, $268,790. Next, we're going to keep moving forward and talk about the new mortgage. So this was a duplex investment property, which is always going to have a slightly higher interest rate than a primary residence and slightly higher than a single family home. So interest rate for this transaction was 6.875. Now keep in mind, your interest rate might be different. You might qualify for higher, lower. Interest rates might be different when you're watching this. But for this real transaction, interest rate was 6.875, and this was a 30-year loan. Next, we're going to input rents on the property. So 2 units. The first side, side A, they estimate is going to rent for $2,750 per month. Side B, they estimate is also going to rent for $2,750 per month. Now, let's say this property also had a garage that they wanted to rent out for maybe $150 a month. All right. If you input that, that rent is not going to be calculated because we selected that this is only a 2-unit property. So the total rents are only going to account for these first 2 units. If you have additional ancillary rent that you're going to be getting, you would want to add it to one of these 2 fields here. All right. But in this case, there was nothing like that. There's just the 2 units that they're going to be renting out. You can put notes over here on the right-hand side. If you say, maybe we're going to rent on 12-month term with renewal in February of 2024. All right. So one really important thing that I like to do is I like to put these spreadsheets together when I'm looking at properties, but then when I buy a property, I actually save this so that I can go back and reference it later and see how close was I? Was I pretty close on my rents? Was I really far off? And then I update this spreadsheet and hang on to it and review it every single year while I own the property to make sure I'm still getting a good return on my investment. So this is a place where you could put in notes for just a reminder of when that rent is going to be renewed, or any other important notes you want to put in here. All right, continuing down, we're going to talk about some details on the market. First thing we're going to have is the vacancy factor. Now, vacancy, if you're not familiar, is what portion of the year is that property going to be vacant? All right. Now, right now in Denver, vacancy is very, very low. Single family and duplex vacancy, I believe, is below 4%. And that is historically low. All right. There's been times that vacancy has been upwards of 8, 10, 12%, particularly during the Great Recession, particularly during some downturns in the past. I like to use a 5% vacancy factor. It's kind of worst case scenario, right? We see right now vacancy has been as low as 1% in the past 24 months. But right now between 2, 3, sometimes as much as 4%, depending on the area you're in. I like to be a little more conservative and use 5% as that vacancy factor. Now we're going to factor in rental increases. So the last couple of years, rents have gone up as much as 15% in some pockets of the Denver area. That's been abnormally high, really, really high for rents to go up 15% year over year. On average, over the last 40 years, rents have increased an average of 5% per year. So I like to be a little conservative. So I like to plug in a 4% annual rental increase because we are going to be looking at this property over the long term. The next thing we want to plug in here is our annual appreciation rate. All right. In Denver, homes have appreciated on average over the last 40 years, 6%. If you go over the last 40 years, 6% on average. Sometimes 10% up, sometimes 5% down, sometimes the last couple of years, 20% increase. This past year, I think we ended up with only 4% increase in the Denver metro area in 2022. And, looking forward, are we going to have some good years and some bad years? Yes. But over the last 40 years, it has always been 6% on average. So I like to be a little more conservative and assume that we are going to get 5% annual appreciation. Next is going to be your effective tax rate. So this is a really important number that I think most investors are really familiar with, or most folks, whenever you file your taxes, this is on the cover page, your effective tax rate, and when you get that information back from your CPA. This is not your tax bracket, but truly your effective tax rate. And you can highlight the tooltip here, and it says, note your effective tax rate is not your tax bracket, but how much you're truly paying in taxes. So if you made $50,000 in income and you paid $10,000 in taxes, that would be a 20% effective tax bracket. Now, this particular buyer is in a pretty high tax bracket, and they don't have a ton of expenses, so they're actually at a 32% effective tax rate. We do see some people as high as 36, 37, depends on your individual situation. If you make less money or have less income, you might be at a 25% effective tax rate. So that's just going to depend for you individually. All right, now next one, do you pay for property management? I'm a big advocate of property management. I love my property manager. They do a great job. They make my life very easy, but not everybody does pay for property management. So there's a selection here. You can choose no, and then it does not factor in anything for property management. If you choose yes, Yes, you do have property management, and you can select the percentage that you pay on a monthly basis. I would say the industry average is right around 10%. There are some property managers that charge less. I know some that charge as little as 7%. There's some other property managers that charge as much as 15%. Or if you have a short-term rental property manager, they might be charging as much as 20%, sometimes 22 to 23%. So this is where you're going to plug in your average for property management. In this case, I do know that this property is self-managed, so we are going to choose no for property management. Now, the next thing we're going to do is plug in monthly reserves. So what are reserves? This is money that you need to set aside every single month for repairs and maintenance on the property. So this is going to be things like the water heater goes out, the kitchen sink breaks, the dishwasher breaks, and we've got to buy a new one. So reserves are set aside every single month, and those expenses, though, don't necessarily happen every single month. The expenses generally happen all at one time. For example, we're saving $100 a month, and after 6 months, all of a sudden, the dishwasher breaks, and we need to spend $400 from that savings to fix the dishwasher. So reserves are that money that you're setting aside for those repair and maintenance items that come up periodically. Now, depending on the type of property, if you have a condo, especially a newer condo, you might select as low as 5% reserves. If you've got a property that's a single family home or something that's been recently updated, you might only need 7 or 8% reserves. In this case, this was a property that was built in the 70s. It is updated, it's well maintained. However, it's a bigger property. You've got a larger roof. You've got more things that can happen in a duplex as compared to a condo. So somewhere between 7 and 10% for reserves. In this scenario, this is a duplex, so I would say let's choose 10% for reserves. Now, is there a homeowners association? If yes, you check that box, and then you would type in the monthly HOA dues. In this case, this is a duplex. There is not a homeowners association, so you choose no on this box, and it does not give you any expenses for the HOA. Now, additional expenses, real estate taxes. For this property, taxes were $4,056 per year, and insurance was $3,408 per year. And then you could put notes over here. This was the 2022 assessment, and maybe this was insurance with State Farm. Need additional quotes next year. All right, because maybe they want to check with Liberty Mutual or Geico or whomever it might be. This is a reminder that currently they've got State Farm and they want to shop around next year when the insurance comes due. Next, you've got utilities. Now, by and large, utilities are often paid by the tenant. Particularly in this case, they've got separate electrical meters and separate water meters. So utilities are not paid by the owner. Those utilities are paid by the individual tenants. So water, sewer, trash, electric, all of that's paid by the tenant. However, they do have some costs for landscaping. Because this is a duplex, they've got some common areas that they need to have the grass mowed. They may need to do snow removal, things like that. Landscaping, you might estimate maybe $1,000 a year. And let's say snow removal, maybe $500 a year. Okay. And then you can put any other notes that you want in regards to these. So let's say utilities. Utilities are paid by the tenants. Okay. And then if you want to add any additional notes about this property, you can do that here. So that is everything that you need to fill out on the inputs page in order to have all of the information and data into the spreadsheet. And now we can start looking at the results and figure out, is this a good transaction or is this a property that we want to buy? So the next thing we're going to do is click on the cash flow tab. And this is going to give us our cash flow statement. Let me zoom in just a little bit here so you guys can see this more clearly. So based on all the information that we've input for this sample duplex, this is a 2-unit property with a purchase price of $825,000. The mortgage is $618,750. Down payment is $206,250. Net costs to the buyer. So that is closing costs, acquisition costs, and then remember, we got a seller credit that paid some of these costs, $22,540. And then we've estimated $40,000 for repairs. So this buyer was prepared to put in $268,790 in order to purchase this property. Next, we're going to go to the annual cash flow statement. And so what we're going to see is the annual rental income. So $5,500 per month. So $2,750 per side times 2 is $5,500 a month times 12 months is $66,000 per year. And the first thing we're going to take out for expense is vacancy. Now, you may not have vacancy over the course of the first year. You rent the property, and as soon as it's rented, your tenant never moves out. Great. But in the future, there's going to be some times that tenants are going to be moving out. You've got a vacancy for half a month or 1 month. You want to always factor in there's going to be some period of time that that property is not going to have a tenant in there. And so that's what that's accounting for. Next, you've got reserves for repairs and maintenance. So we estimated 10% of this annual rent, which is $6,600 a year. Property taxes from the 2022 assessment, property insurance with State Farm, and then utilities paid by tenant, water, sewer, trash, no costs to the landlord for that, and landscaping, roughly $1,000, snow removal, another $500, and any other expenses, you would put those in here. In this case, we don't have anything, but you could input those on that back on that inputs page. So total annual expenses for this property, $15,564. So we've got our income minus vacancy for our expected annual rental income minus total annual expenses gives us our net operating income of $47,136. Now, what is the largest expense? Of course, it is always the mortgage payment. In this case, $618,000 at 6.875. That expense is $4,064 per month. Times 12 months is a total $48,777 per year. So we're going to subtract that from that net operating income. This property is losing an estimated $1,641 per month. So let's look at what does this mean for our returns. So our cash on cash return, if you're not familiar with this number, this is the cash we've invested, $268,790, and we're losing $1,641 every single year. So that is a negative 0.6% cash on cash return. We put in $268,000, we are paying in additional $1,600 every year. So not a super great deal from a cash flow perspective. Let's look at the cap rate. So cap rate is the way that you can compare across multiple asset classes. So we're looking at a purchase price of $865,000, purchase price of $825,000 plus the $40,000 of renovation. So total value of $865,000. Prior to the mortgage, the net operating income is $47,000. That gives us a 5.4% cap rate. Actually pretty good in the Denver market currently. And then one of my favorite numbers to look at is gross rent multiplier. So you take that value divided by the monthly rent, and that gives you a gross rent multiplier of 157.3. Now, for a number of years, the gold standard of gross rent multiplier was 100, meaning if you had a property that cost $865,000 and you could rent it for $8,650 a month, that is a home run deal. Those deals are very few and far between, very difficult to come by in the Denver market. Really what I like to see is anything between a 135 to 160 oftentimes makes sense. All right, and I think you guys are going to see this is at that upper range. And remember, gross rent multiplier, lower is better. This is at that upper range of that 130, 135 to 160, 165. But I think this is still a pretty good deal. And I would love to hear what you guys think in the comments down below. So those are our initial first year returns. Now let's dive in and talk about the return on investment quadrant. And this is where our friend James Orr really added a lot to this spreadsheet when we started working with him a couple of years ago. So over here on the right-hand side is what we're going to look at to begin with. All right, cash flow, this negative $1,641. That's the same number that we've got from up here on our annual cash flow. Now, the next thing we've got is depreciation. This is the true cash benefit that the owner gets from depreciating this property. Now, how does depreciation work? You have a property that's valued at $865,000, And the IRS says you can depreciate that property over 27 and a half years. Now, I'm not sure how they picked 27 and a half years, but every year you can take a portion of that property and depreciate it and get a tax write-off for basically wear and tear on the property. So this is the true cash amount that this landlord is getting from depreciation. All right, so they've got this $865,000 divided into 27 and a half years times their effective tax rate. So this is the actual dollar amount of benefit that they're getting. And that's actually going to show up on their tax returns in the form of a tax refund or reduction in the amount of taxes that they're paying. So a lot of people initially look at this and say, you know what, Joe, I don't want to buy this property because it's negative cash flow of $1,641. That's true on a monthly basis, but you need to look at both of these. This is your cash now, this cash flow and this depreciation. The cash flow, of course, is negative every month, but on April 15th, when you file your taxes, you're going to be getting a refund or a reduction in your taxes of this $8,160. So let's actually do the math here. Negative $1,641 plus depreciation benefits of $8,160 in cash, you're actually cash flowing $6,519 on this property when you factor in those depreciation benefits. Let's divide that by 12 months. That's $543 a month. Now, it's important to understand these depreciation benefits. You don't get that every single month. You just get it when you file the tax returns. But I think if you keep that in mind, this is not a negative cash flowing property. It's actually positively cash flowing when you look at it on an annual basis. The next return we're looking at is debt pay down or debt reduction. So when you buy the property, you get a 30-year fixed rate loan and you're paying principal and interest. Every month, a portion of this payment, this $4,064, a portion of that goes towards interest and a portion of that goes towards principal. Well, the principal is being paid down. And let's not forget who's paying down that principal. The tenant is, because the tenant is giving you money. You're then sending it to the mortgage company. You're paying down that principal. That is a return that you are getting because that is helping you build equity and build value into that property. And you're not the one paying it. So you're actually getting a very sizable benefit from simply paying the mortgage every single month. Now, this bottom side here, debt pay down and depreciation, this is relatively fixed and not guaranteed because nothing's guaranteed, but as long as you make the payments and you depreciate the property, you're going to get this return. All right, so really important thing about investment properties is you're getting this return of greater than $14,000 just by simply paying the bill and by depreciating the property. And these are both benefits that you get by simply making the payments and filing your tax returns. And both of those things are good things to do anytime you own an investment property. Now, the next one we've got is appreciation, $41,250. Now, I want you to pause for a second and remember, we bought this property for $825,000. Let me bring my calculator back over here. So $825,000 times 0.05% means that in the first year, this property is going to gain $41,250. All right. Now, in the second year, hopefully it goes up another 5%. In the third year, 5%, so on and so forth. Now, we all know properties are not going to appreciate exactly 5% every year. Some years are going to be better. Some years are going to be worse. But this is assuming our average 5% appreciation. And so this left-hand side of our return on investment quadrant is your cash in the future. The right-hand side we said is our cash now, our cash flow that we're getting. That left-hand side is our real estate piggy bank. The way you're going to tap into that equity is by selling, refinancing, or taking out a second mortgage on the property in the future. So it's more difficult to access that return on the left-hand side, where it's easier to access that return on the right-hand side. And then the top of this quadrant is more speculative. All right, cash flow is not guaranteed, appreciation is not guaranteed. They are more speculative in nature, whereas that bottom side is more certain and more ongoing. Okay, but the appreciation and the cash flow never guaranteed, but it is a big return that adds up over years and years. So we're going to total all four of these quadrants And we're going to see that this property is going to return $54,207 in the very first year. All right, now let's think about that for a second. $54,207, that's a lot of money. Now, we don't necessarily get all of that money. It's not necessarily deposited into the bank, but a portion of it's deposited into our equity, which is like a bank. And then a portion of it is deposited via cash flow and depreciation, which really is deposited into the bank. But over the course of 12 months, this property is going to generate a $54,000 return. Now, let's look at this on a percentage basis. Our total cash investment was this $268,790. So let's take all of these four quadrants and divide it into that initial cash investment. So our cash flow, this is a negative 0.6% cash flow. This is exactly the same as our cash on cash return. Our depreciation is a 3% return. Our debt reduction is a 2.4% return. And our appreciation is a 15% return on investment. Now, a lot of people say, well, wait a minute, Joe, the property is not going up by 15%. That's exactly right. It's not going up by 15%. It's going up by the 5% that we input, but you financed 75% of the property. So you're only investing 25% down, that $268,000, but you're getting this appreciation return on the entire property. And that's the power of leverage in real estate, which makes real estate such a great investment as to compared to some other investments that you might be reviewing. When you tally up all of these four returns on investment, you get a 20% return on investment in year number one. So I want you to think about that for a second. I would describe this as a very solid deal. I would not describe this as a home run. I would not describe this as a great cash flow deal because we are going to have a little bit of negative cash flow. But with all of the negatives of this and high interest rates, that's what everybody's worried about in today's market, this investor is still making $54,000 per year in year number one and a 20% return. Take a look at your IRA, your 401k. Raise your hand if you got 20% last year in your stock and bond account. I didn't. I don't know if I've ever gotten 20%. I've had some really good years, but this is just an average deal, and they're getting a 20% return. Pretty darn good in my mind. So now let's look at our additional tabs. We've looked at year number one. That's what this cash flow tab is telling us is year number one. Let's go and check out our long-term analysis. This now shows us year number one. It's our same cash flow tab. And at the bottom, we've got the value of the property. We've got the mortgage balance and total equity. And then we've got appreciation, cash flow, debt reduction, cash flow from depreciation for our same return on investment quadrant right here. So all of this in column number one, this is everything that we just saw on the cash flow sheet. Now then we're going to move forward 1 year to year number two. And what you're going to see is rents have gone up. Now why? Because we selected that rents go up by 4% per year. You're also going to see an increase in repairs and maintenance. Why? Because we've said that repairs and maintenance are a function of the total rents. You also see an increase in taxes and insurance. Why do you have that? Well, everybody's favorite word right now starts with an I, inflation. All right, the spreadsheet assumes inflation at a 3% annualized rate over the next 30 years, which is very common over the past 30 years. So this assumes that landscaping is going to be more expensive, snow removal is going to be more expensive. Everything in the property is going to become more expensive with one exception. You have one line item that is inflation protected, the mortgage. That's the benefit of getting a 30-year fixed rate mortgage is rents go up, expenses go up, but that mortgage stays exactly the same. All right, so this payment of $4,000 seems really expensive right now. But when this landlord keeps this property for a long period of time, 10 years, 15 years, 20 years from now, that mortgage payment's not going to seem nearly as expensive as compared to the results they're getting. Continuing down, you can also see how much equity is being built up in the property, what is the cash flow, the depreciation return, and the debt reduction. And now in year number two, they're making $58,000 a year, which is a 21% return on their initial investment. So in this spreadsheet, you can scroll over to the right And you can go as far out as you like. And you'll see once you get to year number 5, we actually compress it, and then we take jumps in years in 5-year increments. Year 10, year 15, year 20, year 25, and year 30, and then year 31 when that property is completely paid off. So let's look at year number 31. Let's just say they've made every scheduled payment. They never made any additional payments. Where do you end up in year number 31? Well, rents have now gone up to $214,000. Seems like an outrageous number, but guys, this was based on a 4% annual rental increase every single year. Taxes, repairs, maintenance, everything has gotten more expensive with one exception. The mortgage was still $48,000 a year. It was paid off at the end of year 30, and now there is no mortgage on that property. This property now cash flows $165,000 per year because you're no longer making a mortgage payment. And the value of this home has increased at a regular 5% annual appreciation to $3.7 million. Now, what does that do for our return on investment? We're now getting appreciation of $178,000 a year. You're getting cash flow of $165,000 a year. There is no longer any debt reduction, no longer any depreciation benefits, but this property returns $343,000 per year after 30 years when that loan is paid off. This is more than you invested on day one. They invested $268,000, which is back over here to the left. They invested $268,000, and now that property is generating more than their initial investment every single year once the property is paid off. Another cool thing that I like to look at is the return on investment quadrant. When do you get to a 100% return? Meaning, when does this property generate your initial investment every single year? So there's a little hyperlink box right here that says see all years. You can click on that and it will show you every single year of the analysis. All right, so now we can see year 6, 7, 8, 9, 10, etc. Let's scroll over and see when do we reach a 100% return on investment. If we're making every scheduled payment right here in year number 26. After 26 years, this property pays the investor enough money to replace their full investment every single year. All right, so that's a number that a lot of people like to say is how quickly can I get to the point where this property is paying me back annually for my full investment. Now, this one takes a little while. It takes 26 years to get there. All right, but sometimes you have a property that appreciates faster, or sometimes you have a property that you put less money down. If you buy a property as your primary residence and you only put 5% down, you have to live there for at least 12 months. But then once you move out and you rent it, you might generate greater than that annual return, greater than that initial investment annually very, very quickly. All right, so it's all a function of how much you put down, how much the property appreciates, how much you can rent it out for. But in this case, it takes 26 years with every scheduled payment for this property to be generating the full amount that they invested on an annual basis. All right, so you can dive into this, you can make changes to it, you can find out, what's my time horizon? Maybe I want to keep this property for only 10 years. Well, what happens at year number 10? That property is worth $1.3 million right here. It's got a $529,000 loan. I could sell it and take $800,000 of gross proceeds. However, maybe I don't want to because the property is now generating $20,000 per year. So this allows you to really dive in and figure out when's a good time to sell, when's a good time to maybe refinance, what are the benefits of holding this property long term. So that is our long-term analysis. And then the very last tab before we look at the new things on our spreadsheet is what do we do if we take the cash flow and apply it towards the principal balance, okay? So a lot of my investors are just regular people, just like me and you. They buy properties, they hold those properties for a long time, They have regular jobs, just like you and I. They're engineers, they work for the city, they're teachers, they're plumbers, they're electricians, they work in finance. They're just regular guys, or regular women as well. And they have a job that pays them, and they don't need the cash flow, right? What I mean by that is the cash flow that the property generates of $500 a month or $100 a month or $1,000 a month, that's not cash flow that they need to live on. And so a lot of my investors choose this route where they take the cash flow from the property and pay it back towards the principal, reducing that principal faster by taking the cash flows and paying down the principal. So that's what this very last tab does, is this shows us year number 1, we're still negative cash flow. So there's no additional cash flow to pay towards the mortgage. But in year number 2, there's $334 additional. So what do? We don't take that as cash flow. We take that and apply it towards the principal. And now we are paying the debt down on a faster basis. And so when we go over here to the right, we're going to see, let's expand so that we can see all of the years of this transaction. You're going to see that this debt is going to be paid off sooner than 30 years. What do you know? It's paid off about halfway through year number 19. So year number 20 is really the year that you want to look at. By applying all of that excess cash flow back towards the principal, this is now going to generate you cash flow of $104,000 starting in year number 20. Now, the only thing different that this investor did from the first scenario is they took all the excess cash flow and applied it back towards the principal. This allows them to have the property paid off a full 10 years in advance and start generating much, much more cash flow much, much sooner. Now, going that route, let's see when we reach 100% return on investment, going to be a year or 2 earlier. All right, year number 25, that property is now generating enough return to have paid for itself every single year. So this is a great way to invest in properties and make a large amount of money over a long period of time. Let's be clear about that. All right, 20 years is a long period of time, but it's a heck of a lot faster than waiting a full 30 years to pay off that mortgage. So I hope that this tab makes a lot of sense. Hope this gives you some good ideas. So now let's look at some of the new features in this spreadsheet that we've added for version 7. Let's go back to our inputs tab. All right, this is all the same information that we input at the beginning of this video. And let's expand this spreadsheet a little bit. It's going to be a little more difficult to read on your phone or on your computer. But what you're going to see is there is now a quick results dashboard right here on the right-hand side. Let me zoom in, make sure you guys can see this okay. So with the information you've input, the return on investment quadrant is now right here on page number 1 based on all of the information that you've input. There's also graphical examples of what you're going to see on this property. So this annual return on investment in dollars, the white line is your total return on investment. That's the return that you're getting every single year. And you see in year number in year number 31, this is now returning $343,000 per year. Each of these other lines, the yellow line is the depreciation. That remains mostly flat because it doesn't really change until year number 27.5. Your debt reduction, you do achieve more debt reduction every single year because as you're paying less principal, you have more debt being paid down. Appreciation does accumulate over the years because the appreciation is 5% of the property value. As values go up, you get more dollar amount of appreciation. And the green is your cash flow. And you see that really improves right there at the end when that property is paid off. It's also important to note that you achieve positive cash flow in year number 2. Sometimes they can take longer or sometimes less time to achieve positive cash flow, depending on how much the rents are as compared to the property price. Also depending on how much the rents are compared to how much you put down. So the more money you put down, the sooner you're going to achieve positive cash flow. But if you put less money down, you may get a higher return on investment because you're investing less money. And we're going to look at a couple of those scenarios. So this is your dollars for your return on investment quadrant. The next graph is your return on investment percentage. So same thing, yellow is depreciation, red is your debt pay down, green is your cash flow, blue is your appreciation, and white is your total return on investment quadrant. So what you see, year number 26 is where you are achieving 100% annual return on this property. And then the third graph, this is what happens if you take all the cash flows and apply it towards the principal balance. You again achieve positive cash flow in year number 2, and then you're receiving no cash flow for the first 19 years. All right, no cash flow for the first 19 years because you're taking all of the cash and applying it back towards the principal balance. And then that property is paid off in year number 19. And year number 20, you begin with full cash flow on that property, and you lose your debt reduction, right? Your debt pay down. You no longer have that benefit once the property is paid off because it's been paid off. But you see that you're still going to result in this $343,000 total return on investment. So over the course of 30 years, the return on investment dollars is the same once you reach year number 31. But in this scenario of applying your cash flow towards the principal, you're going to achieve positive cash flow or a paid off property a lot sooner versus waiting 30 years for that mortgage to be paid off. So this is all right here on page number 1. It is also on your cash flow tab where you can see all of this in real time on your results page. All right, so this is a great way that you can take a quick glance and see, are these good properties? Is this achieving the return on investment that I want? Now, what if you say, you know what, Joe, I really like this, but I want a property that's going to appreciate faster. Okay, great. Maybe you need to buy in an area where properties are going to appreciate at 7% per year. What does that do for you? All right, first thing it's going to do is remind you that the average national appreciation is 6%, so 7% is relatively aggressive. But that moves up the year that you achieve 100% return on investment. What if you say, you know what, Joe, I think 5% is about right, but I'm going to rent this property for more money. I'm going to rent it for $2,900 a month, and I'm going to rent the other unit for $2,900 a month. Well, what happens there? Now we're going to see you're going to achieve your 100% return on investment quadrant sooner. If you're applying the cash flow towards the principal, you're going to have the property paid off about a year sooner. What if you're able to negotiate for a lower purchase price? What if you purchase this property for $805,000? And what if the property doesn't need as much work? It only needs $25,000 worth of work. What does that do? You're going to achieve positive cash flow right in year number 1. Your return on investment quadrant, you're going to achieve 100% in year number 25, and you're going to have the property paid off in only 17 years. All right, so you can make these changes depending on what you're looking at and what are the variables with this property, and you can quickly glance right here on this dashboard and see, what does it do for you? What does that do for your results? Let's maybe even look at one other scenario here. What if we were to do a primary residence for this property, live in one side, rent out the other? Let's just put 15% down. Now we're going to have mortgage insurance, and we can select monthly or upfront. Let's say we do upfront single premium mortgage insurance. We're going to achieve positive cash flow in year number 3 after we've moved out of the property. It'll be paid off in year number 20. And we're going to achieve that 100% return on investment quadrant in year number 19. So you can make changes to all of these fields. You can change all of these variables, and the dashboard will give you these quick results. It'll show you your first year return on investment quadrant as well as all the graphs so that you can see your return on investment quadrant over the entire 30 plus years of owning the property. So I hope this has been helpful for you guys. If you want to get a copy of this spreadsheet, you can of course get that from our website, loansbyjoemassey.com. You can email me. I'll be happy to send it to you. And then as a quick reminder, everything that we offer here at Castle & Cook Mortgage, we do conventional loans, FHA, VA, USDA, jumbo, investor cash flow loans, home equity lines of credit, second mortgages. We can help you with a purchase, refinance on your primary residence, second home, investment properties, just about any type of property that you might need. Don't forget our QR code is here that you can scan to download our mobile mortgage calculator. And please make sure you follow us on Facebook, Instagram, LinkedIn, TikTok. And if I can do anything to help you or answer any questions, always feel free. Call, text, email, put a comment down below. Would love to chat, love talking about real estate, and would be happy to help you with anything that you're looking for any type of long-term permanent financing. Have a great day, and I'll see you guys again soon.